Will the Bank of Canada deliver another 175 basis points of rate cuts by the end of next year? Let's dive into it. According to TD and CIBC, they think this will happen. And also later on, we're going to talk about why people more than ever are having to rely on gifted down payments just to get in the market and what that looks like. So we all know that the Bank of Canada has cut interest rates and the prime rate by about 50 basis points or 0.5% over the past few months. And it has definitely provided some relief for some borrowers. Forecasts suggest that there's a lot more cuts to come over the next year and a half. And really it just all depends on what forecast you follow, right? All the different banks have different predictions. And borrowers are obviously hoping that those forecasts come true, with both predicting that we're going to see around 175 basis points of more cuts by the end of next year. So that's 2025. What that would do is it'll bring the overnight rate back down to 2.75%, comfortably within the Bank of Canada's neutral range of between 2.25% and 3.25%. And we have not seen this level since early 2022. And what I'll do is I'll show you this chart, right? And it shows the path to 2.75% from all the different banks like TD, CIBC, RBC, BMO, and Scotia. You can see that BMO's prediction is around 3.5, and then TD, CIBC specifically think that the rates will come down to 2.75% by the end of next year, right? So they are the most optimistic on the biggest amount of cuts. Whereas you see Scotia and BMO, they're a little bit less optimistic, right? They think the rates will be just above 3% still, 3.25 and 3.5%. And from this chart, it seems like the biggest rate drop will be around Q1 of 2025. So the banks are really seeing that in the winter, this upcoming winter of next year. I think that's where they're predicting the economy is going to be in the worst position, where they're going to have to cut the most, because all of them, that's kind of where the decline is the highest, right? And also Q3 of 2025. So to me, this shows that the banks are preparing for a lot of shock over the next year and a half. They're predicting that people are going to get payment shock, that the economy is not going to be in a great position, because the bank needs to slash rates to stimulate the economy. So the banks are preparing for all of this, right? They're preparing for all of this with these forecasts. And a lot of them say that inflation is the main indicator to watch. So inflation and unemployment are going to be the two key things to watch over the next year and a half. That is how the banks formulate these forecasts over time. In the latest monetary policy report, the Bank of Canada revised its GDP growth forecasts, while its inflation forecasts remain largely on track to reach its 2% target by 2026. So we can see real GDP growth in 2025 is expected to go up 2.1%, and real GDP growth for this year, 2024, is up 1.2% versus the 1.5% April forecast. And then obviously CPI inflation hasn't changed this year. It's been 2.6%. Next year, they are predicting around a 2.4% CPI inflation. It shows that the banks are seeing a possible inflation increase next year, right? And if that does happen, that's not going to be good for the markets, right? That's why they're forecasting these rate cuts into the end of next year, because if inflation creeps up, if the economy starts doing bad, that's where they need to step in and stimulate the economy, print more money, decrease the interest rate. Because if things get hard for people, that's where they have to step in. TDC's long-term growth decelerating below its long-term average to a growth rate of 1.8% annually. At the same time, it sees population growth decelerating and consumer spending experiencing a period of below-trend growth through 2026, as Canadian households save more in the face of high mortgage debt. By 2026, it expects the bank's benchmark rate to return to 2.25%, or another 225 basis points worth of easing, to a level not seen since mid-2022. So what I'll also do here is post a historical trend of Bank of Canada rate cuts. What you can see is through different dates on the left, you'll see the month and the year and the different easing cycles in the main part of the chart. Then you'll also see below that the different tightening cycles, right? The easing cycles are done when the bank sees that the economy is starting to deteriorate and needs help. Tightening is when the economy gets too hot and needs to be slowed down. Bank of Canada kind of uses the interest rate like a thermometer, and it takes time for those things to work themselves into the economy. It doesn't happen right away. It takes time, right? So since we've just seen a 0.5% decrease in the rates, that decrease is going to take its time to work itself into the system, right? We're not going to see the effects of it until maybe a year and a half from now. Because right now, I believe we're starting to see the economy really get bad now. Because it's been now just over a couple years since we really hiked those rates. So now people are really feeling the pinch. So let's talk about what this means for mortgage rates. The Bank of Canada brings the overnight target rate all the way back down to 2.75% by the end of 2025. That would suggest a prime rate of around 4.95%. So given the typical spread between the overnight target rate and the prime rate for variable rate borrowers, this would translate into a lot of savings, okay, significant savings. To put it into perspective for you, reduction from the current prime rate of 6.7%, which it is today, to 4.95% with lower variable rates as well as other loans like personal home equity lines of credit by 1.75 percentage points, or 175 basis points, as we call it in the mortgage industry. And so to give you an example, for every $100,000 of mortgage debt, this reduction would save borrowers approximately $1,250 annually in borrowing costs. These savings obviously add up quickly, providing much needed financial relief for struggling borrowers. For instance, let's say a $400,000 mortgage, the annual savings would be around $5,000, significantly easing the financial burden on many households, right? So if those cuts come in at the right time, it'll allow people who are really feeling the debt burden to feel a bit of relief. These savings would obviously benefit approximately 30% of Canadian mortgage holders with variable rates, including both fixed payment variable mortgages where the payment remains constant, but the interest portion varies, and adjustable rate mortgages where the payments fluctuate with changes in the prime rate when the Bank of Canada makes changes in the rate. So while Canadians largely abandoned the variable rate mortgages during the run up that we've seen in interest rates, there's now been a renewed interest now that the easing cycle has begun. Because if we get these huge cuts, like if the TD and CIBC predictions come true by the end of next year, that variable rate mortgage actually looks a lot more attractive right now. As of the first quarter, 12.9% of new mortgage borrowers opted for a variable rate mortgage, up from a low of 4.2% in the third quarter of 2023. So there's definitely more people that are interested in variable mortgages now. But this is obviously down big from the peak of nearly 57% of mortgages that were variable during the pandemic, when obviously variable rates were rock bottom, right? Now to flip to gifted down payments, okay? So first-time home buyers in Canada are relying more on gifted down payments, financial gifts, more than ever, okay, especially as economic conditions have tightened. And I can also tell you from my experience, when I'm talking to buyers, when I'm in an open house and buyers come in, they're starting to come in with parents now. I'm seeing like groups of families come into houses together, and you know that they're going to be in on the deal together. The reality is now families have to group together. Parents come in on the file as co-signers, guarantors to make the deal work. It's really the only way now. They have to increase their purchasing power by bringing in an older generation into the deal. According to a recent study done by CIBC, 31% of first-time buyers receive family help for their down payments, a significant increase from 20% in 2015, okay? The average gift amount has risen to $115,000, up 73% since 2019. This highlights the ongoing critical role that parents are having on real estate deals, on family wealth, in home purchasing. And what I believe this is doing is it's really helping mitigate housing inflation, but what it's doing is it's also widening that wealth gap that we're starting to see in Canada, where you have the people that are owning assets or the people that are owning real estate, and then the people that don't have much assets, don't have much ownership in other assets. In Ontario and British Columbia, where housing affordability is particularly stretched, 36% of first-time homebuyers receive gifts compared to the national average of 31%. And obviously, it's been a lot higher in those markets because of the elevated costs and their elevated prices. And what I'll also do is show you a chart from CIBC that is labeled "The Gift That Keeps on Giving for First-Time Homebuyers," which is the percentage of first-time homebuyers that receive gifts and the average gift for first-time homebuyers, which is now above $100,000 on average. This is definitely a phenomenon that is just gaining more and more traction, right? Families helping each other, if possible, to go in on the deal. Maybe a mom or dad goes in on a deal with a couple or a family, and what happens is their assets are now on the deal, so it looks safer to lenders, and then the couple is now able to increase their purchasing power and qualify to purchase a home. So that is what I've been seeing personally. That is what is in the data. Love to know what you guys think about this and about the Bank of Canada potential rate cuts into next year, what you think that'll look like. If you guys enjoyed this video, if you like it, really helps me push this information to new audience that might really benefit from the information. And until the next video, guys, take care.